This is our Forex blog for October 25th, 2011. Some days trends last the entire day and other days they don't. Today, we had a mixed trend. As you can see with the dollar and the yen, which most people trade, we had starting the day off more upwards intensity for the dollar than downwards. And, then we had about an hour and a half of a decent amount of weakness, and then the strength resumed. Underneath the real-time bar by bar statistical strength, which is made up of 5 different statistical trend tools. 3 of them measure the direction using different methods. One of them measures the intensity on the intermediate time frame scale, and the next one measures intensity bar by bar. So anytime you have a plus or minus 80 where the dotted white line is, you have incredible strength or weakness. Underneath that we have the intermediate time frame trend, daily, weekly, and monthly. So the dollar and the yen are both in downtrends longer term, but for the most part had counter trend up moves today. The yen, as you can see, from about 3 to 6 had more intensity to the downside, lower and less bars of intense strength. There was about a total of 10 minutes of incredible counter trend up moves, whereas the rest of the waves were down. So basically, if you're trading this today, a lot harder than many of the other days where trends just kept going and going and going, and as long as you traded with the trend, you were going to make money. Today was a little tougher. Normally we look for currencies that show weakness on all time frames and trade those against the strongest pair, which without any doubt is the Australian. Incredible strength today. The daily, weekly, monthly trend is as far up as it can go. The Australian's going up against every other currency. So if you traded this against whatever currency was the weakest, today the New Zealand was weak consistently throughout the day. It's pretty much a no-brainer. You would have had no problems making money today. If you tried to trade it against the dollar, which had some strength followed by weakness, strength followed by weakness, the longer term trend is down, you obviously would prefer to trade the dollar and the yen to the downside. Well, let's take a look at the Australian New Zealand. Strong Australian, weak New Zealand, and this is very likely to go up. And as you can see here, pretty much an entire day it has. So you knew that the Australian was strong, other than from about 3 to 5, which you can see it still went up against the New Zealand because the New Zealand was weaker. And once that strength resumed, you had many opportunities to buy pullbacks in this currency. Now you might have got into a trade here, lost, got back in again, made 20 pips. Currencies where one is for the most part just going up and the other one's going down with a lot of intensity, usually you can just draw your fibs on here and have a little bit of a wider stop, maybe underneath the fib target down here. Have this as your profit target. You're risking maybe 20 pips to make 40 pips. So that's a good 2-to-1 risk versus reward trade. Now the Australian also is very likely to go up against the dollar and the yen, which have longer time frame trends that are down. But you just have to be a little bit more careful because they had some intense counter trend moves today. And at least you know that. Without our tools, a lot of times you don't see that. Here this currency is going up, pulls back to the hourly, decent place to get in. It went up 20 pips, pulled back down and broke through the hourly, so I wouldn't really have taken that trade. As you see in the currency meter, the dollar just had a lot more intensity today than the yen. The yen would have been the safer one to trade against the strong Australian. Which, by the way, later in the day lost its strength for a few hours and then an hour or so here. Oh, and it looks like, I had to scroll back. Hold on a second. I apologize for that. Somehow I had this set on the previous day. So, totally different scenario here. Let me adjust this to make sure that all of them are lined up on the right side. Okay, here we go. So the Australian actually, when I was looking at it, thinking that it was strong, had some weakness, and then from 3 to 4 had some strength, again 6 to 7, and pretty much from 8 onward it was weak. So now that everything's lined up here, you can see a lot of strength in the euro, the New Zealand, like I showed before, which was lined up to the right. I had to scroll back from yesterday and didn't notice that. So the Australian dollar obviously went up. The CAD for the most part was strong today. You could have traded the CAD against the weak New Zealand as well by selling the New Zealand CAD. I pretty much focused on the weekly trend, which is the second from the bottom here. And up until 9, which, this one had incredible weakness. Obviously, it was a news event. The New Zealand was weak too, but the CAD was the weakest one at that time, and which caused, this huge move up. But until that happened, you always have to watch when the news releases are. You have a trade right here which didn't really work. The next pullback trade right here. Usually when a currency makes a lower low, if it doesn't continue, it will reverse. If it can't get over these swing highs, it's very likely to continue its downtrend. And it did, and most of the time markets will go to the first or second fib target. You might want to get out of half your trade here and the market's going sideways. Then you draw your fibs or your stop right over the sideways range. And most of the time it's not going to go beyond the next fib level down of this last little wave, which you can see it's right at the 1.382 of that fib target and the 1.618 of the previous one. This is called a Fibonacci cluster. And anytime you have either a Fibonacci retracement area or two fib targets off of different waves line up, it acts as major support. And the fact that it hit there and went sideways, it's very not likely not to break it. There was some major buying there which stopped it from going down. The euro had a lot of strength today. However, the weekly trend's down, the monthly trend's up. Today was a lot harder day than yesterday and many days in the last 2 weeks. On days like this where you have a little bit of strength followed by mild weakness or less weakness and then a little bit of strength coming in, it's obviously a lot harder to trade. If you spot a day like this, it's nice when you trade the US session on days like this because the market's been choppy all day. You know that you're in for pretty much a scalping session. If you find strong trends throughout the day, it's a lot harder. If the market's up too much, it could continue up another 30, 50, 80 pips, or it could reverse. Those days are a lot harder. But on choppy days like this, you can, if you start the US session, you know that the market's choppy. You trade, whatever is strongest or weakest right now. Like the dollar was stronger than the yen earlier today. It had more peaks, 2 bars here, 1 bar here of strength, less weakness than the strength versus the yen. And so when they both became strong, I would have traded, the dollar against the weakest ones. The New Zealand, the CAD were both weak. And so, after around 8, you'd want to be looking to buy the dollar CAD, and you can see this just absolutely exploded up. And it's very hard on a 5-minute chart to find entries in these exploding currencies. And that's why we use range bar charts. Here's the dollar CAD on a range chart, and I have the build your own trend tool on here, which is incredible. And a little bit after 8, this was extremely strong, and you got this little pullback right here, which you don't even notice on a 5-minute chart. Notice incredible strength, no weakness. I mean, just the most minuscule weakness. You get in, and our intelligent trailing stop, which is based on our statistical trend, the stronger it is, the wider the stop. The more it goes up, the tighter the stop gets. So it's a very intelligent stop that allows you to risk in many cases 6 to 10 pips. And let's say you bought this when it flipped long right here at 57, out here at 21. It's a 60 pip win. And usually when currencies are up a lot like this, you expect a little deeper pullback. I usually am pretty cautious in buying above the white containment band. And when a currency goes down, up, down again, doesn't break this low, and it's this strong, usually it will go up one more wave. You can buy this breakout right here, and most of the time I'm going to exit half my trade at the fib target right here, and the second half when it gets hit here for 56. So you're in at 26, out of half at 68. So you made it probably about close to 30 pips on that trade. Now once it's above the green band, I'm no longer buying. I'm looking to sell the next wave up. And usually the market never goes above the 3.0 green band, but when it does, you can usually get 20-30 pips pullback. Wait for the trailing stop to get hit, go short at 02, out right here at 70. So you made 30 pips on the counter trend. So using the currency meter in the US session, worked extremely well with the dollar CAD because the CAD was the absolute weakest currency. Another one that was extremely weak was in New Zealand. Looking at this currency right here, let's bring the New Zealand dollar up after 8 o'clock when the dollar got really strong. Notice this currency also is underneath the hourly. When it's underneath the hourly, it's more likely to go down. 8 o'clock was when the dollar started to get strong. You have this little breakdown right here. Small profit, short again right here at 98 and out at 57. So it's about a 40 pip profit. You also always want to draw your fibs on the first wave. I try to make the swings as big as possible. I would have exited half my trade here at the first fib target, the lower containment band, and when it came down underneath there and went above this bar's high, somewhere around here at 56, I would get out. Because when it's underneath the lower band, usually you're going to get a counter trend move. And the farther a currency goes, the more likely you are going to get two-wave pullback. And if you watch our video, Elliott two-wave Fibonacci pullback, when a currency is down a lot like this, even when it's extremely weak, wait for a two-wave pullback and you will increase your winning percentage dramatically. Notice how it pulled up, down a little bit, up again. That's the second wave. One wave, sideways consolidation, second wave. Waiting for the second wave up allows you to get short right around 94. The whole number is right above it. The previous day's low is right above you. You got major resistance where you can put your stop right above here, and then you might have got out of this with a small profit here, gone short again, another small profit, because you don't know how far this is going to go. Notice on the way up it had a lot less strength than it had weakness, and when it started going sideways right here, you'd go short again because it had no strength at all, and you might, when the intensity creeps up, look to get out underneath the lower band. But most of these trades are kind of small wins. You'd be short somewhere around 86. You might have got out of here at 66 for 20 pips. But the range chart really gives you a feel. This moves 6 pips per bar. It's not time dependent. So areas like this half-hour period right here where the market didn't move that much, there's not that many bars. When it's really cranking, you have a ton of bars because the volatility is increased. And there's no point of watching a bunch of bars doing nothing. And that's why, in my opinion, the range bars are vastly superior. Now, looking at some of the other trades on here, when a currency is underneath the hourly and comes back and touches it, this is called a retest. It usually, when it can't get above there, it's a safe place to go short. Same exact thing with other resistance areas. Previous day's low acts as support. Once it breaks, it acts as resistance. When it couldn't get back above here, the intensity in the up move was 1/4 or 1/3 of what the maximum weakness was. This is a trend that's very likely to continue, and that was one of the bigger continuous moves. Again, out of half at the first fib target, out of the second half somewhere down here at 55. Your average exit would have been around 60, and you might have gone short here at 03 with a nice 40 pip win. One 40 pip win can get rid of 4 10 pip losses and 8 5 pip losses. You might have a mix of and you got to really think about your losses and your wins as an average. You might make 3 pips on one trade, 30 in the next, 10 on the next, right? So your average is about 13 pips. Your losses, you might have 10 pips in one, 3 in another, and 5 in the next. So that's 18 pips divided by 3 trades. You have a 6 pip average loss. And that's what you got to think about when you're trading. You got to do whatever you can to keep your losses as small as possible without getting jigged out of the market with a noise. You should put your stops above and below swing highs and lows and above and below support resistance areas so the noise of the market doesn't get you stopped out too much.